Pay your bank to hold your money and smile when your loan balance shrinks by itself. That is negative interest rates, and they are not science fiction. You have felt the edge of this without knowing its name. When your savings account pays almost nothing, when government bonds yield less than your phone bill's late fee, when home prices jump even as the economy feels slow, that is the shadow of interest falling through zero. Why care now? Because whether you rent, save, invest, or run a business, understanding negative interest rates decides whether your cash quietly erodes or strategically multiplies. This is why your landlord suddenly demanded a higher rent while your grandmother's savings earned almost nothing. This is why your friend in Denmark bragged about a mortgage so cheap the bank practically apologized. And this is why your paycheck buys less each year even when you swear you did everything right. Something invisible pushes money to move faster. The label most people miss: negative rates. Here is the problem in your day-to-day life. Safe money no longer feels safe. Park $10,000 in the bank for a year, and you expect interest to add a little extra. With negative rates, the extra flips direction. You get a tiny haircut. Or you dodge the haircut, but only by earning near zero while prices keep rising. You work, you save, and somehow you still feel like you are running in sand. Why is this happening? And who decided it? The reason is simpler than you think, and more important. Central banks learned a trick to kick a weak economy. They pay banks less than nothing for holding idle money. And that is where the real story starts. Imagine an entire economy as a giant network of pipes filled with water labeled money. Valves control flow. Open them. Water gushes through loans. Investments. Paychecks close them. Flow slows. Interest rates are those valves. When a central bank, like the European Central Bank or the Bank of Japan, turns the main valve below zero, it essentially charges banks for letting water sit in the tank. If banks keep reserves parked at the central bank, they pay a fee. Most people think banks love charging you for everything and would not mind paying a little themselves. But here is the twist. Banks hate paying to sit on cash, so they start pushing the water out. How? They cut loan rates to lure borrowers. They nudge savers away from deposits. They buy assets, which pushes up prices. Step by step, below zero rates tilt the entire landscape. Let us map it. Step 1. The policy rate goes negative. Step 2. Big banks say we will not eat all of that cost. They slice deposit rates for large corporations first, sometimes charging them a small fee to keep huge balances. Retail customers mostly escape direct charges because people can pull out paper cash. And banks fear customers walking. Step 3. Bond yields sink. Government bonds in parts of Europe and Japan trade with negative yields, meaning if you hold them to maturity, you know you will get back slightly less than you paid. Weird? Yes. But pension funds and insurance companies sometimes accept that tiny loss because regulations force them to hold safe assets. Step 4. Mortgages, car loans, and business loans get cheaper. In Denmark, some mortgages went so low that borrowers effectively paid less than the principal they owed over time. Not free money exactly. Fees and structure matter. But the direction flipped. Step 5. The currency often weakens, which helps exporters but makes imports pricier. Cause, effect, consequence. Open valve, water moves, your world changes. Wait, it gets stranger. Negative rates do not just push people to borrow, they push everyone to choose. Keep cash and lose ground to inflation. Or take more risk and chase higher returns. That chasing does not stay polite. Stock prices climb, real estate jumps. Fine for owners, brutal for first-time buyers. Remember your rent going up 20% in 2 years? Cheap financing poured jet fuel on demand. Developers bid more for land, landlords raise rents to match, and the spillover hits your budget. And if you run a small bakery, like Maya on the corner, negative rates flip your daily math. Her bank begs her to expand ovens, delivery van, a second location. Payments look tiny, she signs. Great when demand keeps up. Dangerous if it does not. But there is a catch. People think negative rates are the economy's cheat code, free borrowing forever. Here is what nobody tells you. Below zero policy can distort the very muscles that make an economy strong. Banks rely on the spread between what they earn on loans and what they pay on deposits. Squeeze that spread too hard, and banks lend less to small businesses. Because thin margins make every loan feel risky. Pension funds promise retirees a certain income stream. Negative yields make those promises harder to keep, so funds buy riskier assets or tighten benefits. Long-term savers get punished, which feels unfair, and pushes them into investments they do not fully understand. The goal is to fight deflation and kickstart growth. But the side effects creep into everything from home prices to your parents' retirement. So why did central banks go negative in the first place? Because during slumps, imagine the years after the global financial crisis, in the mid-2010s, traditional rate cuts hit zero. And the engine still coughed. Inflation ran below target, unemployment hung stubbornly, high growth felt fragile. Theory said, if zero does not unblock the pipes, go through zero. Better to penalize idle money than let the whole system stagnate. And in the short run, it can work. Countries that tried negative rates often saw weaker currencies, easier credit, and a jolt to asset prices. Households refinanced mortgages. Companies issued cheap debt. Governments financed deficits at ultra-low cost. But here is the part that changed everything for me. Everyone fears negative rates mean banks will charge you as a regular saver. In practice, retail deposit rates rarely go below zero because of cash. You can always withdraw physical bills and escape the fee. That cash floor matters. It is like a trap door that stops you from falling too far. For corporates and wealthy clients with giant balances, though, fees happened. In Germany and Switzerland, large deposits faced custody charges. Investors bought safes. Insurance companies rented vault space. Feels absurd, right? Paying for secure storage is normal for gold or art, but suddenly cash itself became like art, something you store and protect at a cost. And this is where things get interesting. Negative rates change behavior in subtle ways. A tech startup might stay alive longer than it should because investors can raise money cheaply and do not feel urgency to demand profits. Economists call them zombie firms. They consume resources without improving productivity, which drags on long-term growth. Meanwhile, households with variable rate mortgages celebrate lower monthly payments and spend more at restaurants, which boosts demand. Two opposite poles. Stimulus today, potential fragility tomorrow. Remember Maya's bakery? Cheap loans helped her grow. But when wheat prices spiked and her neighborhood's foot traffic declined, she still owed the bank. Negative rates made borrowing easier, not risk vanish. But wait, do negative rates make your loan balance literally shrink on its own? Sometimes. A few Danish mortgages had interest so low that after fees and structure, effective interest dipped below zero, trimming principal slightly with each payment. More often, you just pay extremely low interest, which speeds up how quickly your payments hit principal. Either way, the math gifts borrowers time and punishes idle cash. That transfer is the whole point. The policy pushes money into motion. Let us zoom out to currency. When a central bank goes negative while others stay positive, capital looks for better yields abroad. Money flows out, the local currency falls, exporters cheer, and imported goods cost more. If you buy gadgets priced in dollars while your income is in euros or yen, your shopping cart gets heavier. And if multiple countries push below zero, the advantage cancels and we get a global race to the bottom. That happened in the late 2010s. Europe, Japan, Switzerland, each tried versions of negative rates. The world did not collapse, but the pains accumulated quietly. Bank profitability squeezed, savers frustrated, housing frothy, and inequality debates sharpened because asset owners gained more than wage earners. You may be asking, why not just print cash and hand it out instead? Central banks did use quantitative easing, which is large-scale bond buying, alongside and negative rates. But QE targets the long end of the curve. Negative policy targets the short end and the incentive to hoard. They work together. Pull down yields across maturities, make saving expensive and investing attractive, and hope growth wakes up. The risk is that everyone becomes addicted to cheap money. When inflation finally picks up, raising rates hurts, payments jump, asset prices wobble, and the hangover arrives. You lived this recently when mortgage quotes jumped hundreds of dollars a month after rate hikes. That whiplash felt so brutal because the prior decade trained everyone to believe money would stay nearly free forever. Here is a common misconception. Negative rates equal generosity. The reality is arithmetic. If inflation runs at, say, 2% and your savings yield zero, your real return is negative 2% already. Negative nominal rates just make the loss explicit instead of hidden. Most people operate under the illusion that zero is neutral. It is not when prices rise. So the smart move is to focus on real returns, the return after inflation. That single shift in mindset changes your decisions. You stop comparing your savings rate to zero and start comparing it to inflation. You stop feeling rich sitting on cash that loses purchasing power. You act. So what do you do with this knowledge? Begin with your cash tiers. Keep a true emergency fund where safety trumps yield. 3 to 6 months of expenses, maybe more if your income is volatile. Accept that its real return may be negative during low or negative rate eras. That is the price of insurance. Then move the next layer, the money you do not need for a few years, into instruments that can outpace inflation while matching your risk tolerance. That might mean high-quality bond funds when yields are reasonable, or broad stock index funds when your horizon is long enough to stomach swings. If rates ever approach zero or go negative again, consider refinancing debts aggressively, especially variable rate loans. Lock in low fixed rates if you can. That protects you when the cycle turns. And if you are a renter wondering why landlords suddenly hold all the power, trace the chain. Cheaper financing lets investors pay more for buildings. That increased price needs higher rent to justify itself. When policy deepens affordability problems, your options shift. House hack with roommates to split inflated costs. Negotiate longer leases in exchange for small rent reductions when vacancy rises. Or, if work allows, consider moving to markets where cheap money did not inflate housing as much. This is not about giving up. It is about playing the field you actually stand on. Here's the part most people miss. Negative rates are not permanent. Central banks use them as tools. And tools change. When inflation surged recently, many countries moved rates sharply higher. The pendulum swung. If you understand the mechanics, you do not panic, you rebalance. When rates rise, cash stops bleeding as fast, bonds regain yield, and overvalued assets can sag. You rotate accordingly. The power is not predicting the exact rate next month. The power is knowing the consequence map. Lower rates push you toward risk, raise asset prices, and weaken currencies' higher rates, pull you back toward cash yield, cool assets, and strengthen currencies. Once you see the map, the news stops feeling random. Remember the hook? Pay the bank to hold your money and smile as your loan shrinks. That felt absurd at first. Now it reads like a lever you can spot, weigh, and use. You learned that negative interest rates are a policy choice meant to get money moving, that the costs and benefits do not land evenly, and that your everyday life, your rent, your savings, your mortgage, sits downstream from those decisions. Most people drift through this blind. You do not. You know that zero is not neutral, that cash has a real return, that cheap money helps borrowers and pressures savers, and that each turn of the valve sends ripples through housing, jobs, and markets. So the next time someone whispers that rates might go below zero, you will not freeze or scoff. You will ask the right questions. What does this do to my emergency fund? Which debts can I refinance? How do I protect my long-term goals without chasing every bubble? You will recognize the bakery owner deciding whether to expand and see the currency shift when a central bank blinks. You will make deliberate moves while others react. And when the cycle flips again, you will flip with it. Not because you are guessing, but because you understand the machine. Negative interest rates are not a monster under the bed. They are a switch on the wall. Now you know where it is, what it controls, and how to use it without letting it use you.